Good afternoon. Welcome to BizTech Asia's Midday Market Watch on the, what is it today? 18th of March, 2024. The year is just flying past. Maybe it's my age, I don't know. I'm Jeffrey Halley, and my guest today, and a great friend of the show, is Vishnu Varathan, who is the head of economics and strategy at Mizuho Bank in Singapore. Vishnu, welcome to the program.
Always good to be here, Jeff. Thanks for having me on this afternoon.
Let's just have a quick look at markets around Asia first. What stands out, of course, is the Nikkei 225, which has risen by 2.21% today. Quite an impressive rally. Elsewhere, it's a bit quieter around Asia. Shanghai is up just 0.5%. Hong Kong is up 0.2%. Down in Australia, the ASX 200 is down just 0.05%, nearly unchanged. In South Korea, the KOSPI is up 0.64%. Singapore is almost unchanged as well, down 0.03%, as is KL, with the KLSE down just 0.01%. Vishnu, I guess the Nikkei and the KOSPI are standing out today, but what are your thoughts on today's market moves?
I think markets are really bracing for quite a slew of central banks, starting off with the BOJ and RBA on Tuesday, very quickly followed on by the Fed, the Bank of England, the Swiss National Bank. We also have got the Taiwanese and the Indonesian central banks, along with the Chinese central bank. So it's really a plethora of central banks adding to a lot more noise. And all else equal, it does appear that markets are doing one of two things. One, I think they're positioning cautiously ahead of the Fed, in particular, in light of some of the hot data that have come out. And so they're positioning such that they don't want to be caught wrong-footed, particularly long in risk, if indeed they push back on when the first rate cuts or the extent of rate cuts that could come through this year. The second thing that markets are doing, of course, is they're perhaps trying to front run and see the type of moves the BOJ might make. And oddly enough, I think some optimism seems to be coming through on the front that you'll land in a Goldilocks position where the BOJ indicates that Japan is snapping out of deflation, but without rocking the boat too much.
Yeah, if we look in currency markets, we can see that dollar yen has risen above 149. So the yen has given up some of its more recent gains. But elsewhere, the dollar is still looking quite robust as well, particularly after that rally on Thursday. But overall, currency markets have gone really quite quiet since Friday and into today. And do you think that is also currency markets sitting on the sidelines now waiting for something to happen?
Yeah, I mean, and here's the thing, they don't know exactly what's going to happen. With the Fed, the so-called easy trade of shorting the dollar on a Fed pivot, that's been blown out of the water with the hot inflation prints, the jobs data. In fact, I think markets are quite nervous that quantitatively and visibly you could see a step down in the so-called dot plot, the number of rate cuts the Fed might do this year. And so they're bracing for a knee-jerk lift in the dollar and in US Treasury yields if that happens. So for those reasons, some of the easing that we saw in the dollar in weeks that passed have reversed out. But equally, if you get a run of other central banks coming to weigh in on their views on last mile inflation, it entails significant two-way risks. The BOJ in particular, we don't know how much the BOJ will allow the yen to rise, even if they were to calibrate policy. We've seen late last week, Governor Ueda pushing back on notions of a tightening cycle per se. So I think the uncertainty is twofold. The first thing is we don't know exactly what the BOJ is going to do, given that they tend to be more cautious than markets give them credit for, and they've got a whole range of policy tools they could tweak. So really, this permutations increase the risk of not hitting it hitting the nail on the head. The other aspect of the BOJ policy is even if the BOJ were to do something, they tend to push back on excessive yen volatility. So traders are quite circumspect about how much they can push the envelope with the BOJ bets.
Let's stick with the BOJ. I mean, the market has seemed to have got itself all wound up that they're going to start hiking or start tightening policy rates for the first time in, I believe, 14 years. I mean, what's your house view on this outcome? Because when I look at the domestic consumption numbers out of Japan, they're pretty weak, even if other sectors are showing much more resilience. On the other hand, we've also seen some pretty chunky wage settlements enacted last week in Japan as well. So although you said it's finally balanced, from my point of view, there is a chance that they may extend that caution into April or even June.
No, that's a really good point, Jeff. And I think you summarized it really well in pointing out the soft spots that are there. The way we look at it, I think right now the BOJ has to tread carefully between what they actually want to do, which is, I think, exactly to your point. Let's defer this to April or June, versus how markets might react if they don't do enough. So given market expectations, they don't want to kick up volatility. So we think it'll be a mix of walk and talk. Talk would be with regards to yield curve control, how they might bring back quantitative easing and do away with yield curve control at some point, and they're only considering this, stopping ETF purchases, so on and so forth. Whereas in terms of the walk, they're probably going to do a rate hike, but highly conditional one, which is to say they're going to say, look, we're going to do a one-off to zero rates or 0 to 0.1% rates, very controlled. But we are going to pause for a long time to assess this because, as you rightly pointed out, there are two factors. One is domestic consumption in particular remains weak, even if tourism has lifted some of the numbers. The second point is, yes, the wage negotiations, particularly the Rengo negotiations, came in much stronger than expected. So hooray for that. But the BOJ is not ignorant of the fact that a lot of the exporter earnings that were, of course, amped up by the FX, which is a much weaker yen, gives them the space to give higher wage increments, whereas this may not be sustained if the yen strengthens because your dollar then converts into fewer yen onshore. So there is there's a caution there about getting carried away with this wage increments being sustained. And so for those reasons, I think that's why they're going to move cautiously.
Let's move away from Japan then. I mean, the other big event, as you touched on this week, is the US FOMC and Jerome Powell and his colleagues. Again, my feeling is that inflation is perhaps a little more sticky, as you said, in that last mile than previously hoped. But also, the US economy seems to still be doing quite well. So perhaps there's not the urgency there from the FOMC to signal that they're going to enact a big series of rate cuts. I mean, what is your house position on the FOMC? Are we going to get any surprises this Thursday Asian time?
No, certainly not. I think they're certainly not going to cut. The optics of it would be very difficult for them to explain away and maintain policy credibility. As you pointed out, it's all about US exceptionalism and sticky inflation. And so really no reason to ease yet. Though we think there'll be quite a bit of show and tell. The show will come from the dot plot. Our suspicion is there's a lot of murmurs about just needing for two of the voters to shift before the dot plot drops to 2 rate cuts for the year, not 3. But I think that's rearranging the deck chairs on the Titanic, because I think what they might really agree on is it's a matter of time before they cut. And the sticky inflation is an inconvenience, not an impediment per se. The other point is, and this is the one I'm curious about as well, because back in December, Jerome Powell shifted gears dramatically. In fact, he did the equivalent of a handbrake turn when he said, look, last mile disinflation, he doesn't see it as a particular problem. No reason why it should be so different to what we see now. And so that lowers the barriers for them to enact rate cuts as the broader trend of disinflation continues. And he sort of repeated that to some extent, saying that he doesn't need to see better data, just more of the data on disinflation. And so along those lines, if he assuages fears about the pivot pushback being extreme or extensive, I think some of that extreme strength in the dollar or heightened upside volatility in yields, those might be tamed to some extent.
Mm-hmm. And sticking on the central bank theme, because to paraphrase the musical Chess, this is the central bank show with everything but Yul Brynner this week. And so we've got Bank of Indonesia, we've got the Bank of England, we've got Taiwan, we've got the Swiss National Bank, we've got the Reserve Bank of Australia, and I'm sure I've missed some. Amongst all the rest of that group, are we expecting anything other than unchanged, or are they going to be sitting there watching what the Fed's doing?
Well, the short version is it's predominantly unchanged. Just look out for the Bank of England, whether they signal that they are more willing to cut than they were previously, because then you need to impute Bank of England perhaps leapfrogging the Fed. And on the RBA, I think they would be the one that stand out in saying that they're not yet committed to a cut. But I think the looking under the hood, that's going to reveal that the next move must be a cut. It's a matter of timing. And so that will not give the Aussie any particular leg up.
Yeah, I can remember the Bank of England during the transitory inflation stage of the development in the markets a couple of years ago. They were an outlier in saying that it wasn't transitory inflation at all. It was going to be much stickier than everyone expected. And they were proved to be completely right, as the rest of the world central banks got it, well, horribly wrong, as we know in hindsight. So it would perhaps be a bit logical that they may actually be ahead of the curve on this one as well. Are you expecting anything from China with the policy rates this week as well? Can we expect a rate cut from them? Because if any big economy in the world probably needs a bit of stimulus, it would be China at the moment.
You're certainly right on the stimulus, but the modality of that might not be the rate cut, not in the particular 1 year at least. The policy rate, they've already cut the 5-year ones to signal on property markets being supported and mortgages being supported. In addition, we've seen that they've actually ramped up credit. So credit growth for Jan-Feb was much stronger than last year. So I think they're comfortable where they are. Crucially, they don't want to risk undermining or compromising renminbi stability. So for those reasons, I think they will maintain the policy rate for now at least.
Vishnu, thanks so much for being on the program today. That's been a really comprehensive roundup of all the central bank action this week, and there's a lot of it.
Thanks for having me on, Jeff. Have a good one.
We've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank here in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley, and this video and podcast will be available on our website, www.biztech.asia, as well as our social media platforms, and also our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in today.